People are not, except in certain places like San Francisco, overall they're not, really excited. And maybe it's good reason not to be that excited about prospects in the housing market.
Those are big words coming from a guy who's sort of like gospel on housing. When I started out my career, like 3 or 4 decades ago, it used to be home sales. You got home sales, then they went to existing home sales, then they started bifurcating with new home sales, mortgage applications, permits, all of it. We now get 7 or 8 different housing stats, but the most important, the most scrutinized, is that Case-Shiller index, which sort of keeps track of home prices around the country and the region. So when a key author behind that index starts saying, you know what, yeah, we have a bit of an uptick, but doesn't think it's going to last and doesn't think it's noteworthy and doesn't think this is the beginning of a big housing boom, take note. David Lykken is excited about housing. Tim Rood, not so much. So, David, what do you make of what Shiller is saying here? Don't get ahead of yourself.
Well, I think the number one thing is he makes some good points. He's got a lot of data points. He is the guy that has so much historical data. But here's what I've been interested in. He says it's not exciting. This market's not going to be exciting. I haven't been excited about the fact that we've had double-digit price appreciation. That causes for a lot of discouragement. The fact that we're back down in the 4% range, even if we get down to the normal 4% range, that is exciting, Neil, because it's a sustainable housing cycle, and we can see consumers
I see where you go. That actually
in.
makes good sense. In other words, if you fear that it's getting out of range for you or too frothy for you or you can't leap on this, I see where you're coming. Tim, what do you think of that?
Hi, Neil. Yeah, I wouldn't worry about Robert Shiller working any suicide hotlines in the near future.
Yeah,
He's not a very optimistic guy.
Yeah, I would just finish yourself off if I were you. But yeah.
Well, yeah. No, what I would say is I think it's going to be kind of uninspiring for the next few years, but that's not necessarily a bad thing. To David's point, you don't want to have 10% appreciation rates every year. We came out of 2012 so hot. 2013 was good.
I do. I'll tell you why. As wacky as it sounds, we were so badly beaten down. And so many properties that have yet to recoup their value from the last housing uptick, that we would have to have that for a number of years just to get close to parity. What do you think?
Well, I think you're right. I mean, obviously, you're about 10% off the bottom, or at least 10% from the highs that we experienced. There's 2 things going on. One, there's no supply. I mean, because of the 15 million properties that are underwater or basically have a little equity, they're mostly in that 200,000 and below. Those are the starter homes. The good news is the demand side, which are all these millennials that have crawled their way out of their parents' basements and are now renting, they're not ready to buy. So it's actually a good time to have this kind of status, this 2% appreciation rate, because when they come out 2 years from now and have robust jobs and have some credit history, you're likely to see that demand come back.
All right. Now, David, there is this notion interest rates start moving up, home prices, whether tepid or not, start moving up, continue moving up. Fence sitters get off the fence. That is a bullish underpinning to housing. Do you buy that?
That's absolutely accurate. People move, but it's how quickly rates rise, Neil, that are going to be a key factor. And he mentioned in his segment with you yesterday that there's a psychological factor. The psychological factor works to our advantage with a slight increase of interest rates. And I think the Feds are going to keep this very much in mind. There's nothing the Feds want to do to disturb the housing market. And you're going to put a bullet through the housing market, and we're going to see housing market hurt if we see 2 interest rate increases this year. That's why I say that there's going to be more rhetoric about that and less action. We may see one, and I think there's an increasing number of credible people saying we may not even see that in spite of what the Feds say. So the psychological factor is one that I think is going to weigh into this. It's working to our advantage now. If we see rates spike up, it's going to work in negative psychological factor.
Real quickly, Tim, I think Greece has just taken a rate hike off the table this year. What do you think?
Yeah, I think for sure. And not to mention, as David mentioned, we've learned about D.C. They don't have the stomach for mass defaults. And there's only 3 ways out of these credit bubbles. You can either grow your way out. We ain't doing such a good job there at negative GDP. You can inflate your way out, which we're really comfortable with, or you can default. And we've already demonstrated that's not going to happen. And housing is 20% of the economy. I wouldn't expect policymakers to change their tune. They'll do anything they can to bail out that market.
All right, gentlemen, thank you both very, very much. Go ahead, finish that point,
Dave. Good to be with you. I was going to say, Fannie Mae default ratios, the Sears defaults are the lowest they've been since 2008. There's some good news on the serious delinquency front, so that's an added benefit to what's going on in housing.
Good points all. Gentlemen, thank you.